For a lot of people, seeing their stocks rise in price is reason to celebrate. But maybe you should prefer seeing the stocks that you've just bought go down in price. After all, it's a chance to buy more of a good thing at a better price. If you're going to save every year and have surplus cash that you want to invest, falling prices just mean that you'll be able to buy more shares in the businesses you like. And over the long term, consistently buying at lower prices is better than making a little bit of money now by selling. The 1970s are currently a really good example of this. So the amount of money that Berkshire has invested in stocks has gone from $11 million in 1971 to $39 million in 1975, and today, in 1978, it's $129 million. Now, yes, part of the reason for that big increase is just having more money to invest. True. But another big reason is that the stock market is a lot cheaper now in 1978 than it was at the start of the decade. A few years ago, pension funds showed us exactly what not to do. They put 122% of their funds in stocks in 1971 when the market was expensive. Just 3 years later, after the stock market had dropped significantly and stocks were nice and cheap, they only had 21% invested. Last year, Warren talked about why return on capital is a better way to evaluate a business than earnings per share. This year, he's added a caveat to that. When you look at return on capital, exclude capital gains in the short run, because in the short term, they're very erratic. But over the long term, include capital gains when you calculate return on capital. They're a better reflection of performance, and obviously, they're kind of important. Now, in terms of 1978 itself, Berkshire has had a very good year. It earned 19% on every dollar of owner's investment. So yeah, a good year. But it hasn't been without its problems. Okay, so the textile business has continued to disappoint in 1978. For similar reasons to those outlined last year, it is the perfect example of an unattractive business. It earns a low return on capital. I mean, take this year. It earned 7% on every dollar invested in the business. Why? Well, it has an undifferentiated good. A textile is a textile is a textile. It's the same no matter which company you get it from. And that means that Berkshire has no pricing power. It's also capital intensive. You have to invest a lot in the business relative to the amount of earnings it generates. One of these characteristics is unattractive, but the combination is the stuff that nightmares are made of. Now, Berkshire is trying to improve profit margins in the business by differentiating the product, making it different to competitors' products, and by using equipment and labor more efficiently to lower costs. The problem is that all of its competitors are trying the same thing, so everyone ends up back at square one. The insurance business, on the other hand, continues to be very profitable for Berkshire, even when you take the great conditions across the board in the industry into account. Now, the interesting thing about insurance is that you don't know what the cost of your product is for a long time. If you run a pizza place, let's say, and it costs you $3 to make a pizza that you then sell for $5, well, cool. You know that your product costs you $3. But it's not so simple in insurance. Your product is basically a promise, a pinky swear, that you'll cover the costs if a risk materializes. The problem is, you don't know how much that promise will cost. You can estimate and guess, but you don't know for sure. Berkshire also owns a bank in Illinois, creatively named the Illinois National Bank. 1978 has been great for the bank. Its return on assets was 3 times that of major banks despite having much less asset risk than those banks. All in all, it's been a good year for Berkshire. The insurance business and Illinois National Bank are bringing in cash money, but the textile business is worrying.